So here we are. Anne is 63 years old and has a life expectancy to age 100. And she's wondering if she has enough money saved for retirement. So we're just going to run this plan. We're going to set inflation at 2%. And at the end of 2018, we expect these will be the values. So we've got a condo here, tax-free savings account, locked-in retirement account, and an RRSP. And she'd like to spend about, let's put this in today's dollars, about $42,000 a year indexed inflation. So let's take a look. If we look at her investments, we can see them as she draws down on them. She'll spend most of the capital here by about age 92, and then there's a gap here. But of course, if we double click on here, we can see there is still some income coming in, and we'll check and see what that is. So pension plans, we've got some guaranteed income supplement, CPP, and OAS. Now, Anne was interested about annuities. So let's take a look and see what happens if we purchase an annuity. And we purchased the annuity here in the LIF. And this is what we paid for it. And an annuity will pay about $14,000 a year. It's not indexed. And this is the principal and interest payment. But of course, that doesn't matter too much because it's all in a LIF. Now, if we do a simple side-by-side comparison, again, just looking at the investments here, we can see, we're spent most of the money here by age like 92, and over here we're getting 93, 94. So we're slightly better off with the annuity. Anne has a question, what if interest rates rise? So let's take a look at that. And what I've done here is actually I've increased the rate of inflation to 4% from 2%, and we can see now with the annuity, we're actually spending most of the money here, probably what's that, age 85 or so. And this is because with the rate of inflation, the purchasing power of the annuity isn't as high. And let's take a look at that. So here we see this is what the steady payment, but we'll put this in today's purchasing power. We'll just look over time, and we can see how inflation is just eroding the purchasing power. We can see if we go way out here to age 50 or age 95, that $14,000 is now only worth about $4,000. So of course, as inflation erodes the annuity value, we have to draw more from the capital. I guess, however, if inflation is rising, probably interest rates are going to rise too. So of course, Anne was kind of curious. Well, what happens if we just increase our rates of returns to 5%? Because if inflation's at 4%, maybe we'll earn more. So let's take a look at that. And here we go. Now we're back out to, around age 90. Perhaps one other thing we should look at, Anne's suggesting she's making a 3% rate of return on this side. Half the money is in fixed income, half in equities. It's possible she can get a higher rate of return than that. So I've got an example here where she's just making 5%. So an increase of 2% in rates of return, we can see the difference here. We fill this income gap completely. But Anne is conservative, so we may have to deal with this gap a different way. So one thing might be, what if we delay a Canada pension plan to age 70? So this is what Anne expected to get at age 65, but you can see delaying to age 70, this would be the amount that she's going to start to receive. And when I compare those side by side, there's a bit of an advantage here with delaying CPP, but there's not a lot. Let's just dive into this a little deeper. So look at this. CPP, actually I'll put this in today's dollars. So Canada Pension Plan, we can see the difference here, but look at this. Guaranteed income supplement, a higher pension plan over here, we're getting a lower GIS. So here's the difference in purchasing power rate here. So it's not as big as you might have thought by delaying CPP. Now, of course, if Anne had the higher rate of return, still had some RSP money left, she wouldn't be getting the GIS, and delaying CPP would be a bit more pronounced. Okay, so we're coming to the end here, and the last thing Anne was looking at is, what if she sells the condo maybe when she's age 90? And here we are, the condo's been sold, there's an influx of money, and this is what it is here. And of course, the condo could have been sold at any time here earlier if you wanted to. Let's just take a look at the final estate. And what we see here is that at age 100, Anne passes, and the children are going to receive a total of about $412,000. So anyway, I just wanted to run through this. This is an exercise that I like to use with clients in the planning purposes. It allows them to participate in the plan. And the other thing I find when we do it together, that I'm answering your questions. So anyway, if you have any questions about this or anything else, please give me a call or send me an email. Thank you.